Ingrid Smith 1. Emerging market equities. Despite having done well this year, we believe many areas within emerging markets are attractively valued relative to many of their developed market counterparts. We think James Donald, who heads up the Lazard Emerging Markets Fund, is particularly adept at seeking individual opportunities within such a broad area of the market. For those who want to tap into the growing dividend opportunities, Charlemagne Magna Emerging Market Dividend is also worth a look. Point 2. European equities. Improving economic growth, increased political stability and falling unemployment levels have bolstered sentiment in Europe, with M&A activity in the region picking up and IPOs continuing to come to market. That said, there are still pockets of value which can be captured by selecting the right managers. One European equity fund we particularly like is David Walton's Marlborough European MultiCap. While it is overweight smaller companies relative to the broader index, it has a highly diversified portfolio of stocks in a bid to minimize volatility. Marlborough Equities Europe x UK Small Mid is another option. Point 3. Japanese equities. While the Nikkei 225 has indeed performed well this year, it's still around 40% below its long-term peak. Japanese equities have remained unpopular among UK investors in particular, who have been told one too many times that, this time, it is different. However, fresh from a landslide election victory, Japanese Prime Minister Shinzo Abe can continue with his business-friendly reforms. Bailey Gifford Japanese Fund is worth a look, as is T. Rowe Price Japanese Equity. Point 4. Short-duration corporate bonds. Given that central bank tapering appears to be on the cards in some regions, investors would do well to exercise caution within the fixed income space and minimize interest rate risk. Short-duration bond funds, which hold bonds that are close to maturity, could be an attractive option. We particularly like Axis Sterling short-duration bond, which will only invest in high-quality corporates with maturities of less than 5 years. Manager Nicholas Trindade also structures the portfolio so that it is well diversified, and that around 20% of the holdings mature each year. Point 5. Emerging market debt. In today's low-yield environment, emerging market debt looks particularly attractive given its superior ability to generate income. Within this space, Claudia Calix's MG Emerging Markets Bond Fund, which is able to invest in both hard and local currencies as well as a combination of both government and corporate bonds, is a newly rated fund which currently yields 4.9%. We also like Aberdeen Emerging Markets Bond with its 5.2% yield. Point 6. Floating rate notes. Floating rate notes are bonds which have a variable coupon. This is determined by adding the bond's spread to its reference rate, for instance LIBOR or the Consumer Price Index CPI. A fixed income fund we like, which uses floating rate notes, is Ariel Bezalel's Jupiter Strategic Bond Fund, which currently has a 12.3% weighting to the asset class. Likewise, Gamstar Credit Opportunities managers Anthony Smower and Greywar Mivilas have long been fans of floating rate notes. They have 43.3% in fixed though floater bonds which provide a fixed interest for a specified period and then float at a spread over a specified benchmark, which is regularly reset and can move in line with interest rates.